What is adjusting entries? What is adjusting entries? Adjusting entries are accounting journal entries that convert a company's accounting records to the actual basis of accounting. This is made prior to the financial statements of the company and help future investors understand the statement from the business. Adjusting entries includes the cash basis, where accounting records revenue when cash is received and records expenses when cash is paid. On the other hand, there's accrual basis of accounting, which records revenue when they are earned and records expenses when they are incurred. So what does this include? Well, this includes deferred revenue, deferred expenses, accurate revenue, and accrued expenses. So what do these terms mean? Well, when a company receives cash before it provides a service, it has a deferred revenue. When a company earns revenue before it receives the cash, it is an accrued revenue. When a company pays for a resource before it uses or consumes it, the company has deferred the expense. And finally, when a company often incur expenses and pay for them later, this happens to be known as the accrued expense. So let's look at deferred revenue. Let's say PlayStation sells a 12-month subscription on its monthly games. On the 1st of January, they receive $1,200 cash for 12 subscriptions. In this case, cash goes up, so that becomes debited. Unearned subscription revenue also goes up, but is revenue, so it becomes credited. Adjusting entry on this after 5 months would result in the unearned subscription revenue going down, which becomes debited, and the subscription revenue going up, becoming credited. Deferred expenses. Say I purchased 12 months of prepaid rent for $36,000 on the 1st of June. Prepaid rent insurance goes up $36,000 debited, and cash goes down credited $36,000. But on the 30th of June, the adjusted entry is only 1 month worth of rent, which is $3,000. So rent expense goes up $3,000 and prepaid rent goes down $3,000. Let's say Alex does $2,000 worth of work on the 1st of September. He bills the customer on the 31st of October and closes the book on the 3rd of November. This means the accounts receivable goes up $2,000 and service revenue also goes up $2,000. Let's look at accrued expenses. Say salaries are $1,000 a day and I pay on the Saturday of the 1st of June for the work done Monday to Friday. This happens to be the debited salaries expense of $5,000 and salaries payable goes up $5,000. So when I pay for these salaries, the salary payable will actually go up, becoming debited for $5,000, and this cash goes down $5,000. This is the process of transferring all revenue, expenses, and dividend account balances to retained earnings. Each account revenue is reduced to zero by debiting it, and each expense account is reduced to zero by crediting it. Thus, the balance of ending retained earnings for a period shows a